Ticker symbol, ALMR. Welcome to The Explainer. Today we're locking in on a company that's quietly trying to rewrite the rules of the entire life sciences sector. Let's just get right into it.
Meet Alamar Biosciences. Now, if you're looking for a traditional biotech drug developer that's just waiting around on a coin flip FDA approval, you are definitely in the wrong place. Alamar is a life sciences tools company. They're pioneering this fascinating space known as precision proteomics. Basically, they've built a hardware and chemical platform centered around their proprietary NULISA technology and these Argo instruments that's designed to find and measure proteins existing in just vanishingly small amounts. To put that into perspective, it's literally like trying to find a specific grain of sand in an Olympic-sized swimming pool. They aren't making the drugs themselves. They're making the highly advanced, incredibly precise picks and shovels that the rest of the medical research world desperately needs to strike gold.
Okay, let's dive into this. You might be wondering, why does measuring these incredibly low concentration proteins actually matter? Well, it's because these proteins act as the early warning systems, the literal biological biomarkers for some of the most devastating human conditions out there. We're talking cancer, Alzheimer's, severe neurodegenerative diseases, and complex immune disorders. Historically, trying to find these proteins in a standard blood draw was, well, it was like looking for a single needle in 1,000 haystacks. But Alamar's technology allows researchers to actually see those needles, and better yet, to measure a whole bunch of them simultaneously without losing any accuracy. This opens up a massive market opportunity, scaling all the way from pure academic research right up to widespread clinical diagnostics.
To really grasp why the data points to such a massive financial opportunity here, you've got to understand their business model. It is the classic razor and blades ecosystem. Step 1. Alamar places their expensive Argo instrument in a lab. Okay, that's your razor. Step 2. Researchers need to run tests, so they use Alamar's NULISA panels. Step 3. These panels and all the associated chemicals, they're consumables. They get used up and have to be repurchased constantly. That is the blade. And step 4? Well, that's where the magic happens. As the installed base of instruments grows, the recurring revenue from those high-margin consumables just accelerates. It's a brilliant, super sticky ecosystem. The true engine of this business isn't actually selling the machine, it's the continuous mandatory purchasing of those consumables month after month.
And that brings us to their Q2 2026 earnings report. 147%. Seriously, that number made me do a double take. That is how much Alamar's consumable revenue exploded year over year in just the second quarter. While their instrument revenue grew at a very respectable 35%, the consumables absolutely rocketed. This is the ultimate proof of concept for that razor and blades model we just talked about. It signals that laboratories aren't just buying these Argo machines and letting them gather dust in a corner. No, they're actively using them. They're using them intensely and reordering the proprietary panels to keep their research going. The installed base economics for working perfectly, literally turning one-time buyers into lifelong subscribers to the platform.
Now, what's really interesting here is how the overall revenue pie has shifted. Consumables have completely taken over. In Q2 2026, they jumped to 53% of total revenue. Just to give you some context, a year prior, they made up only about 36%. Instruments currently sit at 27%, and services make up the remaining 21%. This is a textbook example of a company successfully transitioning. They're moving away from that clunky, sell an expensive scientific instrument once and hope for the best model, and smoothly transitioning into a highly lucrative, recurring proteomics ecosystem that just generates super reliable cash flow.
And right here is the direct financial reward of that ecosystem shift. As those higher margin consumables dominate the revenue mix, profitability potential rises right alongside it. We saw gross margins jump from 53% in Q2 2025 to a phenomenal 60% in Q2 2026. Management attributes this directly to manufacturing efficiencies and, of course, that heavier consumable mix. Now, looking at the data, it's really important to keep our expectations grounded. Management did signal that margins might fluctuate in the mid to high 50s in the near term as they scale up their operations. So, if you're building a model, I'd suggest plugging in 55 to 60%. But the long-term trajectory? It's absolutely incredibly promising for anyone analyzing their path to profitability.
But there is one number I would focus on above everything else when looking at the health of this company. Look at this divergence. On one hand, you have a massive fortress of a balance sheet, $256.3 million in cash and investments, largely thanks to their April 2026 IPO. Basically, they don't need to raise money to survive tomorrow. But on the other hand, look at the burn rate. Q2 operating expenses ballooned to $31.2 million. That is an 89% year-over-year growth in operating expenses, resulting in a $13.2 million net loss just for the quarter. They are spending heavily on R&D, sales infrastructure, and international expansion. So while the cash cushion is great, cash is not profitability, and that burn rate is something that demands some very close attention.
Despite that heavy spend, though, the fundamental growth engine is just roaring. Management's new 2026 midpoint revenue guidance is $118 million. That represents a staggering 59% annual growth rate compared to 2025. Guiding for nearly 60% top-line growth while simultaneously improving gross margins, that's exactly the holy grail that growth investors look for. It's incredibly rare in the life sciences sector to see a company accelerate revenue at this kind of scale without completely obliterating their margins. The demand for their platform is just undeniable, and they're capturing market share at an absolute breakneck pace.
So where is all this demand actually coming from? Well, one massive catalyst is their expansion into Alzheimer's research. Alamar launched the first commercial multiplexed blood test for something called EMTR-DARTau. Now, I know that sounds incredibly technical, but it's essentially a vital early warning biomarker for Alzheimer's that can be easily detected in a simple blood draw. They're also collaborating with Gates Ventures, building a massive data set of over 140,000 samples. This is strategically crucial. The entire field of Alzheimer's diagnostics is desperately trying to shift away from invasive spinal taps and wildly expensive PET scans, moving towards simple, accessible blood tests. By planting their flag right here, Alamar is positioning their technology at the very center of one of the largest medical addressable markets in the entire world.
But the data shows they certainly aren't stopping at neurology. Alamar recently launched the NULISA Immune 340 panel, aggressively diversifying into immunology, inflammation, and broad drug development. This launch is a massive signal to the broader market. It proves Alamar isn't just some niche, one-disease company. No, they're building a general-purpose precision proteomics platform. If they can successfully serve multiple, distinct branches of medicine simultaneously, from brain diseases to autoimmune disorders, their ceiling gets exponentially higher, literally multiplying their total addressable market with every single new panel they release.
Now, this is where the story becomes much more complicated. Everything we've discussed so far is why Alamar is a phenomenal business. But as we know, a great business isn't always a great stock. Following their incredible Q2 results, the stock surged to around $36.57, pushing their market cap up to $2.15 billion. Because they're deeply loss-making right now, conventional price-to-earnings ratios are pretty much useless here. I mean, dividing a stock price by negative earnings just gives you a meaningless number. Instead, when you look at their expected $118 million in revenue, they're trading at roughly 18 times forward sales. The market has already priced in the recurring consumables, the gross margin expansion, and all that massive growth. So expectations right now, they are sky high.
Let's break this down with a proper valuation framework using enterprise value to sales, basically comparing the total value of the company to the actual cash it brings in. In a base case scenario, let's say where they hit their 2026 targets, keep margins near 60%, and we assign a healthy 10x multiple, the equity value sits around $28 to $30 a share. In a bear case, where growth slows down and the multiple compresses to 7x, you're looking at significant downside toward a $1 billion valuation. To justify the current stock price, you are essentially forced into the bull case. You need 14x multiples, sustained revenue growth over 50%, explosive consumable growth, and absolutely flawless execution to support a share price of $40 to $50 plus. You are paying a premium for absolute perfection.
And this brilliantly illustrates why they are relying so heavily on their competitive moat to defend that massive premium valuation. And this isn't just about having a few patents on the NULISA tech. The moat is built on that expanding assay menu and the deeply sticky installed base of Argo machines. Think about it. Once a lab trains its scientists on a system and integrates those recurring consumables into their daily workflow, ripping that machine out to switch to a competitor, that becomes a massive, expensive headache. Combined with their incredibly large data sets and strategic scientific relationships, they're building a highly robust ecosystem defense against massive industry giants like Illumina and Thermo Fisher Scientific.
However, we definitely have to view this with disciplined caution. The risks here are very, very real. Number one is that sky-high valuation we just modeled out. Combine that with substantial operating losses and operating expenses that are growing almost as fast as revenue, and you have some friction. Furthermore, they're fighting in an intensely competitive proteomics market that heavily depends on macro research funding budgets. This is often the true Achilles heel for companies like this. If big pharma or academia tightens their belts and cuts research spending, Alamar feels it immediately. Finally, keeping a close eye on dilution is totally crucial. Stock-based compensation jumped to $3.3 million in Q2 from just $700,000 a year earlier. Remember, a great company doesn't always equal a great stock at any price.
When we distill all of this down into a single profile, you get this really fascinating barbell effect. On one hand, revenue and consumable growth get a flawless 5 stars. The balance sheet and raw technology, top tier, coming in around 4.5 to 5 stars. But on the other end of the barbell, profitability and valuation drag the overall profile down significantly to just 2 stars. The ultimate institutional takeaway from this explainer: Alamar is an exceptional, high-octane growth engine, but one that is saddled with poor current profitability and extreme valuation risk at these elevated levels. So let's separate the actual business from the ticker symbol for a second. Looking strictly at the underlying business, the consensus data points to an enthusiastic 8.5 out of 10. The 82% total revenue growth, the successful transition to high-margin consumables, the 60% gross margins, and that incredible liquidity of $256 million in cash. It is a phenomenal operational story. They are executing their platform strategy exactly as you would hope, building a true life sciences powerhouse.
But for the stock itself, at its current trading levels, we have to drop the energy a bit and issue a much more sober 6 out of 10. And that is strictly because the narrative has shifted. The secret is out, guys. ALMR is no longer this hidden, emerging growth story that you can buy at a steep discount. It's now an aggressively priced, high-expectation stock where the broader market has already prepaid for a massive amount of future success that hasn't actually happened yet.
Let's see how this builds into a practical framework for the stock price. Under $25, the data suggests this is highly attractive. Between 25 and 30, it's a solid zone to accumulate shares. At 30 to 35, it's reasonable, but really only if you have a very high risk tolerance. But right now, at roughly $36.57, we are firmly in the expensive tier. Anything over 40 requires absolutely exceptional, flawless execution from management just to break even on your initial investment thesis. Therefore, the bottom line takeaway from the research is super clear. Discipline is your greatest asset here. The strategy points to a hold or keeping it strictly on the watch list. Please do not chase the post-earnings spike. The smartest move is waiting for valuation compression or a broader market pullback to give you a significantly better entry point rather than chasing momentum. While you wait, monitor the fundamentals like a hawk. You want to see revenue growth stay above 50%, consumable growth reliably above 70%, and most importantly, you need to see that operating expense line finally start growing slower than the revenue line.
So, the crucial point is this. 2026 is all about growth, adoption, and proving the platform works at scale. But 2027, that is the real test. Can Alamar take this exploding, high-margin consumables business and finally translate it into durable operating leverage, shrinking those massive losses and charting a clear path to true profitability? If they can, this could easily be one of the defining life science tools companies of the decade. But if they can't, the current valuation will be deeply unforgiving. Keep your eyes on the data.